Oil prices have been surging for the last 2 or 3 months. This has a significant impact on the global economy. Welcome to Key Points for October. Firstly, thank you so much for all your comments about the new format. I was a little concerned that it was going to sound like hospital radio or something, so I'm very glad that you like it, but do please keep the comments coming in. This month we look at the surge in oil prices. What does this mean for the global economy? We have the concept about higher for longer for interest rates. What does this actually mean? And the sell-off in equity markets in the last few weeks. Is this likely to continue in the months ahead? Now, turning to the first point, oil prices have been surging for the last 2 or 3 months. This has a significant impact on the global economy. You can see the chart that I'm showing you here. The prices have risen by a whopping 35% since the month of June. And this has been a function of the Saudis and the Russians surprising the market by continuing to constrain supply. But this surge in oil prices has two direct effects. It means that households and companies have to spend more on oil rather than other goods, so it does impact the growth dynamic. And from an inflation perspective, of course, if oil prices had been falling, helping the inflation front going in the months past. But now this dramatic surge in prices is going to mean that inflation is going to be more problematic going forward, both at the headline level, but also seeping into the core. And that's something that's going to keep the central banks very much on their toes. So let's turn to our second point now. This concept of interest rates being kept higher for longer. It sounds very dramatic, but what does this actually mean? Well, you can see by the chart here that interest rates in many parts of the world moved dramatically higher over the last 18 months or so. It's really quite a scary picture. When we look at what's happened in Brazil and Chile, for example, they moved interest rates earlier than most of these key central banks, a whole year earlier. But once they had moved into significantly restrictive territory, they didn't suddenly pull back and start cutting rates. What they did was they kept rates at a high level for quite a long time. In the case of Brazil, a full year before now starting the cutting process. And this is a concern for businesses and households because it means that this isn't a spike in interest rates. It means if you're having to refinance your mortgage or refinance your debt, maybe in 6 months' time, you're still at these very high levels. You can maybe weather the storm for a bit, but the higher and longer interest rates stay at these levels is going to impact profitability, is going to impact spending power, and that's going to impact economic activity. So higher for longer really does matter, and that's one of the reasons why financial markets are beginning to wobble. And this takes us to our third point. Equity markets have been declining as equity investors have been factoring in these higher interest rates. So why do higher interest rates matter? Well, they matter for two key reasons. First of all, higher interest rates means that the discount factor applied to future dividend and earning streams means that investors typically pay lower multiples for that. And that impacts the tech-heavy NASDAQ index in particular. It also means that smaller companies face higher funding costs and access to funding is going to become more restrictive, which will of course impact their earnings and their margins. And this can be seen very visually on the chart here. You can see that this year the S&P 500 has done fairly well, up around 10% year to date. The technology-heavy NASDAQ index did very much better, but look what's happened in recent months. It's begun to turn lower as investors have become more cautious given a higher interest rate environment. And this is also the case of the red line, which is the Russell 2000 smaller cap index. You can see it's now down about 10 or 12% from its summer highs. In other words, it's already in correction territory. So investors are finally pricing in a higher risk premium. Either the interest rates are going to be higher for longer, or that actually the growth dynamic is going to be slowing more appreciably, in which case that will also impact earnings and margins. So remember, the full report, as always, is available on zurich.com/MSME. And please do keep your comments coming in about the new format. They really are much appreciated.